Section 3 of Chapter 21, Financial Statement Ratios. This chapter has one learning outcome, and that is how to find and use financial ratios. A financial ratio is an analysis of your financial data to compare the business's performance with past performance or with other similar businesses. Financial statements organize and summarize information about the financial condition of a business. Using data from financial statements, financial ratios give businesses a way to evaluate how well they are doing. And financial ratios are also used by lending institutions and stockholders to determine the financial well-being of a business. This is why it's important when we study the unit on investments, the way we evaluate companies to determine whether they are a good company to buy, we use financial ratios to help us make a determination on how healthy that business is financially, because that would give a good determination on the long-term success or health or lack thereof of the company as it relates to other companies or competitors in this industry. So how do we find and use financial ratios? There's several different financial ratios that companies use regularly to help it understand where it is, how it's performing, and how it is compared to other companies in its sector. So the first ratio that we will look at is called the liquidity ratio. What is a liquidity ratio? First off, what is liquidity? Liquidity refers to converting assets to cash. So your liquidity ratio is a financial ratio that shows how well a business can be expected to meet its short-term financial obligations. To meet your short-term financial obligations, you need cash. How quickly can you convert your assets into cash in order to pay your short-term obligations? This is the liquidity ratio. Companies need to have a satisfactory liquidity ratio in order to avoid going into debt. Now, going into debt is not always a bad thing. Debt, when it is managed, is a very useful tool that businesses use, but there are times when a company could be over their head in debt, and their debt ratio, we will look at that next, we'll look at that later, and the debt ratio will give us an indication of whether this company is too heavily in debt, or if not, maybe the company could actually add on some debt. Interesting. Working capital. Working capital now refers to your current assets minus current liabilities. That is what we would call our working capital. So when we talk about the current ratio, which is an important ratio to help us know whether the business has enough assets to cover its liabilities. Current ratio is looking at your current assets to determine how well those assets are covering its liabilities. If you owe money to other companies or businesses, you must use your current assets to help you make those payments. So this current ratio is an indication of how well those assets can cover your liabilities. Now, in this case here, we have an example where Aaron's Air Conditioning Company and Zelda Zeppelins. What we're looking at is two different companies: current assets, current liabilities, and working capital. Well, look at these companies. One has only $11,000 in current assets and $5,000 in current liabilities. Their working capital is $6,000. Zelda Zeppelin has a large amount of current assets by the sum of $615,000, but their current liabilities are also large, $609,000. So their working capital is also $6,000. So working capital is the difference between current assets and current liabilities. But both companies have the same working capital, but Zelda's owes almost as much as it owns. You see the difference. Zelda owes almost as much as it owns, but in Aaron's air conditioning company, it owes less than half of what it owns. Aaron's air conditioning company is in a better position financially than Zelda's, even though they have the same amount of working capital. So you can see from one company to the next, the numbers help us to understand a better picture of the health of that company. Let's move on. Current ratio then is found by taking current assets and dividing it by your current liabilities. In the situation with Aaron Air Conditioning Company, his current ratio is 2.2. Total assets, 11,000, divided by total liabilities, or current liabilities of 5,000, gives us a value of 2.2. Zelda, on the other hand, even though they had the same amount of working capital, when you take their current assets of 615,000 and divide it by their current liabilities of 609,000, they only have a current ratio of 1.01. So you cannot look at just the working capital to determine the true current ratio. And these two values are very different. That gives us a better picture of how healthy these companies are. How well can these companies cover its current liabilities with their assets? Zelda cannot cover their assets as well as Aaron's air conditioning company. That's what this number is showing us. So this quick how-to section says, to find a financial ratio, you simply write one amount as the numerator of a fraction and the second amount as the denominator. Write the fraction in decimal form, and for some ratios, you can use it in percent form. That's it. You're comparing two numbers. You're creating a ratio of two numbers. What are those numbers? Current assets to current liabilities. If we say it that way, current assets to current liabilities, then the first item is what we'll use in the numerator. The second item is what we would use in the denominator. So if we look here at this statement, write the ratio of current assets to current liabilities. Look how we write it. Current assets at the top. The word to represents our fraction bar, and then the last item, current liabilities, then represents our denominator. The way it is written, the way it is said, determines the way we write it. If they ask the ratio of current liabilities to current assets, then we have to flip these numbers. First number divided by the second number. Make sure you understand that. So that's your example. Now, when you look at your current ratio, a lot of your banks or your lending institutions like you to have at least a 2 as a minimum acceptable current ratio. Obviously, a larger number shows that you are in a better financial position to cover your expenses. And that is what lending institutions want to know. How well can you pay your bills? How well can you pay them back? They will look at this number to help them determine, will they lend to you or not? Okay, we have another ratio called the acid test ratio. Now, the acid test ratio is the ratio of quick current assets to current liabilities. Quick current assets. All right, only quick current assets are used. What are quick assets? Quick current assets are assets that can be easily exchanged for cash. You could easily get it into cash. Very liquid, we call that liquid, very liquid. Highly liquid assets are assets that can very quickly be turned into cash. If you have a big building that is a storage warehouse, chances are it'll take a while before you can sell that and convert that into cash, especially if not many people are in the market for a large warehouse building. So you can see that would not be a quick asset. You cannot quickly convert that into cash. So that is what we're looking at, assets that can be readily exchanged for cash. Such items would be your marketable securities, stocks, bonds. You can quickly sell them and get cash. Accounts receivable, people owe you money, you can quickly get that money. And notes receivable, they owe you money, you can quickly get that money. You can also sell these accounts receivable to someone else, maybe for a discount, in exchange for quick cash. So we can use these as quick current assets. Now, your merchandise inventory, even though it is a current asset, we don't generally group that with our quick current assets, because a loss would probably occur if a business were to make a quick sale of all their merchandise. So that's the reason why they don't usually use that. You don't want to basically sell everything at a loss if you're trying to get money, because that's not the reason you're in business. You're in business to make a profit. So we don't use that in our ratio for the asset test ratio. So the asset test ratio then takes those quick current assets and divide them by your current liabilities. So if you notice now, they've taken your assets and further broken them down to only those assets that we can quickly convert to cash, and use that number as a ratio with your current liabilities. That gives us our quick ratio, or the asset test ratio. How quickly can we convert assets into cash to pay for our liabilities? Another ratio now would be the ratios that are to net sales. Other useful ratios can be determined from the income statement. The previous ratios that we just spoke about dealt with assets and liabilities. Assets and liabilities are shown on the balance sheet. Now, we are going to use items on our income statement to also help us find some ratios that are useful in determining the financial position of a company. I highlight this as a reminder. Remember, the first amount in a ratio appears in the numerator, and the second amount appears in the denominator. So if they say net sales to total expenses, if they say total expenses to cost of goods sold, whatever order they give you, the first number is the numerator, the second number is the denominator. That's the simple way that you need to just keep that in mind. They will give you the statement, then you would put it in the order based on how they give it to you. And that is how we create our ratios. Remember that. Now, the first ratio we're going to look at with this income statement is our operating ratio. Now, the operating ratio, it takes the cost of goods sold plus the operating expenses, the cost, and then divide that by net sales. So the operating ratio, what does that do? What does that do for us? It tells us, or it indicates the amount of sales dollars that are used to pay for the cost of goods and operating expenses. So in other words, how well is our current operation covering our current costs? A business does not want to cover its current production costs by their profits from previous years. That's not a healthy way to cover your production costs. So you want to be sure that your sales are more than enough to cover your current cost of producing goods for sale. Okay? So that's what this operating ratio is going to show us. Now, an operation ratio of less than 1, it says this, a ratio of less than 1 to 1 is desirable. Why is that important? The lower the operating ratio, that means the more income there is to meet financial obligations. So you just have to understand the relationship of the numbers. Notice the number in the top is the cost. The cost. You want your bottom number to be much larger than the top number, so we'll get a smaller ratio. So that's why a lower number, lower than 1, you don't want to use every dollar of sales to cover the cost. You're just breaking even, basically, when it looks like that. You want more money coming in sales than money going out in expenses. And so this operating ratio lets you know how healthy you are in covering your current operations through your current sales. Another important category of financial ratio are your profitability ratios. These show your relationship between sales and gross profit and net profit. As a stockholder or an investor, you're very interested in these types of ratios because that is going to help you know whether you're going to be able to make money with this company in the buying and investing in the stock of that company. So profitability ratios are very good. The first one we want to look at is the gross profit margin ratio. The gross profit margin ratio shows the average spread between cost of goods sold and the selling price. The desirable gross profit margin ratio varies with the type of business. The industry helps to determine what would be considered a desirable or undesirable number. The industry. Because if all companies in the industry are running the exact same, then they all should be experiencing the same types of situations. Therefore, this is why we say this, depending on the industry, the ratio might be different. Okay, so once we know what industry we're working with, then we have certain ratios, which are your benchmarks. Okay? And in this example here, they say a jewelry store might expect to have a ratio of 0.6 to 1 because there's a high rate of markup in jewelry. An auto parts store, however, might have a ratio of 0.25 to 1. It's a different type of business, different type of industry. So this profitability ratio here, gross profit margin, will be different based on the industry. But how do we find it? Well, we find it by taking your gross profit from sales off of your income statement and divide that by your net sales. So what is gross profit? How do you determine gross profit? Gross profit on our income statement will be net sales minus the cost of goods sold. So net sales minus the cost of goods sold divided by net sales will give us our gross profit margin ratio. You see? So that is important for us to see. Okay, let's go forward. This is an example for us to look at. Based on the income statement, we have an income statement now. And incidentally, as a stockholder, when you purchase stock, you should get a prospectus from the company, and in that prospectus, they should give you the financial statements. And from those financial statements, if you want to do your own investigation, you can look at their income statement, their balance sheet, and you can run these numbers yourself if you want to. But generally, these numbers are already provided for you, so you can see them. But nonetheless, knowing how to get them is always a good thing. So if something is not available, you know how to find what you want based on the information that's given. So based on this income statement, let's find some operating ratios and the gross profit margin ratio. Express them in percent form, rounded to the nearest 1/10 of a percent. Okay. The operating ratio. The operating ratio, once again, is your cost of goods sold plus your operating expenses, all of your costs. How much it costs to produce the product, how much it costs to run your business. These are your costs. How well are your net sales covering your total costs? So from our income statement, we can take our cost of goods sold, this amount, add to that our operating expenses, and then divide that amount by our net sales. That will give us our operating ratio. In this case, we're looking at 83.2%, 0.832 to 1. So that is showing us what the operating ratio is. How well are our sales covering our expenses? Now, this is not so great. In our example, the gross profit margin ratio is found by taking your net sales, subtracting your cost of goods sold from that, and then dividing that number by your net sales. So really, if you think about it, we want to know the difference between net sales and cost of goods sold and the other expense. That's telling us our margin. We're looking basically at your expense of running the business. How well are your net sales covering that? That's showing our gross profit margin ratio. Because if you look at net sales and taking cost of goods sold out, the previous example here, we took cost of goods sold, added the operating expenses, and then subtracted that, and then divided that by net sales. And in this case here, we're taking net sales and subtracting from that the cost of goods sold, and then dividing that back by net sales. So we're seeing what that ratio is giving us. Now let's see, what does this ratio give us when we do that? We're looking at a 0.27 or 27%. 0.27 to 1. So depending on the industry, this could be good or it might not be so good. We need to know what is the standard for this particular industry to really determine how good this number might be or how bad it is. Okay. Now there are other financial ratios that we could use. For instance, the asset turnover ratio, that actually compares net sales to total assets. And in this cases, we're using information from both the balance sheet and the income statement. So you can now see why both of those two financial statements are very important now when we want to determine the financial health of a business. So the asset turnover ratio is going to compare your assets or net sales to your average total assets. And this is going to give you, or at least going to show you, the average return in sales for each dollar invested in assets. The average return in sales for each dollar invested in assets. How well your assets being covered by your sales. Okay? Because you're using your money that you're receiving in sales to help purchase things, right? So this is showing you how well are your sales helping you to invest in the assets that you need to run your business. Okay? So, because let's say you have inventory, you have to buy those products to use in the production of whatever product you are selling. So how well are your sales supporting the ability to purchase the raw materials and other items that you need to create your finished product that you then sell? So it's a connection. This asset turnover ratio, how fast are your assets turning over in the production of business? Now, chapter 18, we talked about efficiency ratios. An efficiency ratio quickly is a measure of how effectively a business uses assets to generate sales. You do not want to be wasting money. You do not want to waste your assets. You want to be able to be very efficient. You want your assets to not be wasteful, but to go directly to producing the products without excess. It's like, for example, if you're building a table and you have a certain amount of wood, you don't want to cut off your wood in odd shapes so that you have a lot of leftover wood that you can't use. That's not very efficient. So if you knew that you needed to create a table 2 feet by 4 feet wide, then you want to make sure that your product that you purchase, your assets that you're having, are cut in these type of measurements so that you don't have much waste. You want to be efficient. That's just a quick example of efficiency. Assets being used efficiently in the process of creating your products. So how well or how effectively you use your assets to generate sales. All right, the total debt to total assets ratio compares your total liabilities to your total assets. Now, this comparison looks at your indebtedness of the company for each dollar in assets. So for each dollar of the value of your assets, how does that compare to the amount of debt that you have? Now, this is called a leverage ratio. Leverage ratios examine debt of a business. This is where we determine whether the company is overly leveraged, meaning too much debt to support its assets. Then we can see that this company, if financial situations got tough, this company might be in a bad situation because it's too heavily indebted. So your leverage ratio helps you to determine, is this company using debt in a healthy or an unhealthy way? So how do we determine the calculations for these? Your asset turnover ratio is simply, you take your net sales to average total assets. Net sales divided by average total assets, that tells you your asset turnover ratio. Debt to assets, so total debt to total assets. Your debt is your liabilities, money that you owe to somebody else. Take the total of that, divide that by your total assets. That shows you your ratio of your debt to assets. How much are your debt covering each dollar of assets? And once again, there is a healthy amount of debt that a company should use. Debt is not necessarily a bad thing. Too much debt is bad. Okay. Now we have these ratios. So now how do we determine or interpret, not to determine, but how do we interpret these financial ratios? This is very important. Interpreting financial ratios. A business has to track its own progress over periods of time. Trends are also used so a company can see how well it is doing over periods of time to know its healthiness. It also gives a company the ability to see how well it is competing with its competitors by using these particular financial ratios. Now, in this chapter, table 21-1, we can see the financial ratio analysis. And it's very important to look at this and understand what the numbers should mean in general. But just know that businesses, lending institutions, and investors are very in tune to knowing these financial ratios that we discovered about a company to determine the health of that company, to determine whether it is good to invest in that company or is it good to lend to that company. So looking at this table now, we can see the current ratio. If the value of the current ratio is less than 1, then that is a sign there's some problems. Too much debt compared to your assets. If it's equal to 1, that's when then that means you are just, it's not the best position. When the value is more than 1, that is when you're starting to look in a favorable, desirable position with current ratios. Your asset test ratio, cash flow could be a problem if the value is less than 1. You're in a satisfactory condition if your current assets and your quick assets, your current liabilities and your quick assets are at a standpoint, at even. But when you go into the point where that ratio is greater than 1, then that is a sign that the company is in good financial condition. So looking at your current asset, looking at the asset test ratio, you really want those values to be greater than 1. That's good from the balance sheet. Now, from your income statement, your operating ratio. If the operating ratio is less than 1, that's desirable. If it's equal to 1, it's marginal. If it's greater than 1, that's not a good sign. You are not making enough money in sales to cover your operating expenses. The gross profit ratio margin, depends on your industry, 0.25 to 0.4 is the industry average gross profit margin. If the value equals 1, it's uncommon except for business with low turnover and high investment. So you got to understand that. And it's going to be very undesirable if this gross profit margin is more than 1. Not desirable. Now you might think, oh my goodness, gross profit, that should be great, the largest number. No, not really. Not really. So we have to look into these numbers to really make sense of what's happening. You're dealing with gross profit from sales divided by net sales and trying to determine how that should look. All right. Your asset turnover ratio, now we're using the balance sheet and the income statement. Sales and assets. Sales comes from your income statement. Assets come from your balance sheet. 0.4 to 1 is the industry average. It is not common for the value to be 1. And it's uncommon also for it to be more than 1. So anything greater than 1, not what you're looking for. And then finally, your total debt to total assets, 0.05 to 0.75 is the industry average. So you want to find ranges between that. The debt ratio is too high if it is equal to 1, and it's dangerously high if it's greater than 1. If it's greater than 1, that means your liabilities are way more than your assets, which means if you liquidate all of your assets, you still might not be able to pay your debt, what you owe. So that number, a large number, is not good. Small numbers are great. That's why the 0.05, that's a really, really good figure, because your liability, your debt is no problem. Okay? 1, as you approach 1, obviously you're getting into the gray zone, because any small blip in the production could cause you to be in a financial problem and make the ability to pay off your debt more of a challenge if your debt to asset ratio is just dead even. So you want to look for low numbers in this area. Okay, that's a lot of discussion for these ratios. Now you can look at these examples and understand some information. Here is this example where our seller would like, now here's how we're gonna need to understand how to apply or interpret and use these ratios. Here's the situation. Our seller would like to apply for a loan to expand her gift shop. Here are the numbers: current assets, total current liabilities. Other information can be found in the previous example. The question is, should our seller plan to expand the business at this time? Now that is a good question. Using the financial statements to make financial decisions. Now this is the crux of this chapter. Understanding the balance sheet, understanding the income statement, and then understanding the ratios that we form from those financial statements, so that the business managers and owners can make these types of decisions. Let's take a look. Her current ratio is 1.81, not bad. Asset test ratio, 0.74, not as good as it should be. Remember, we want greater than 1 for these. Operating ratio, 0.83. Gross profit ratio, 0.27. Asset turnover is on the high side. .82, and then debt to total assets, 0.15. That's kind of low. That's good. So let us find out. In conclusion, here, now based on the information, the current ratio, operating ratio, gross profit margin ratio, and total debt to total asset ratios demonstrates a business with healthy financial status. The asset test ratio may indicate, remember, that was less than 1, that may indicate a potential cash flow problem. It's not a sign that the company is doing bad, but they just don't have enough cash. So cash flow, sometimes companies are cash poor, don't have enough cash on hand. All right? And then the asset turnover ratio shows that the inventory turnover is within the industry average. So she should proceed cautiously in making a decision to expand. That asset test ratio makes us a little bit cautious. This decision should include an analysis of the local economic forecast and the cost of making a loan, including the repayment terms. Because if your cash flow, cash on hand, is being held up through other business practices, then when you go and expand, you get a loan, how easy would it be to get cash to make these payments? But also, what are the forecasts for the industry? If we're looking like the economic conditions are on the upswing, meaning the economy is growing, then that's a good indication that she could be okay to make this decision. That's part of the cautious position she needs to be in. But if the forecast for the economy doesn't look like it's going to be going up, then that might mean that her business might take a downturn. And if it does, then it would be financial hardship if she go ahead and expand at this point based on her financial ratios. So using this information, she looks like she's in a good position to go forward, but with caution. What you can see, it's important for both internal and external decisions for a business to look at the business trends over an extended period of time. So, because of that, we introduced what is called a trend analysis. Now, a trend analysis usually takes a particular period of a particular year and use that year as the basis to compare against other years. So you can quickly decide what year you want to use to create your trend from. That's your base year. So you take the data from all those other years that you want to compare and create your trend from, and base that on your current, whatever year you select. These percentages are then referred to as index numbers. So you take those current year, the current year as your basis, and then you take the amount of the values from the different years and compare them to your model year as the basis, and those numbers then you plot on a chart, okay? And you graph it out and you find trends based on that. So your trends then will all be related to the specific year that you're using as your base year to compare all the other years in your trend analysis, okay? So how do you go ahead and prepare a trend analysis? Well, it is 5 steps. First, you got to determine what is going to be your base year. That is always going to be your base. The base, remember, is always 100% the base. Then you calculate your index number by taking the yearly amount from whatever year you're looking at, divide that by your base year amount. That gives you the index number for that year. And you do that, express the index numbers to the nearest 10th of percent. Then you prepare a table of the base and index numbers. So how many years you have data, you do this step here in step 2. You get all those index numbers, you prepare a table of the base and index numbers, and then finally you graph them. Prepare a graph of the base and index numbers. In those charts, the data looks like this. Notice, in this case, we're using the years 2007 all the way up to 2011. The following data were collected by this enterprise company to prepare a trend analysis of the net sales, the net income, and the total assets. They took the data, and notice the 100% is the 2007 year. So the 2007 year is their base year, the year that they're going to use to compare all the other years by. So once they take that year, it's going to be 100% of itself. Then they're going to take that value as the base. So for the first net sales, like for example, 2008, this 550, 524 will be divided by the 512, 854 to come up with this 107.3. The first column, 2007, of course, 5,012, 854 divided by 5,012, 854 gives you your 100%. So they'll just do that. So they'll convert these numbers into index numbers and then plot it on a chart. And then this chart will show you the trends of these different items that's being used. So depends on what you want to track. If it's going to be sales, cost of goods sold, gross sales, whatever it is, you put that in there and you can create these trends based on the methods we just showed. Okay, there you go. That's all we have for this chapter, and that was a lot, but it's very important information. Go ahead now and work on stop and check. Go slow, go slowly, work it out. Check your answers with what's in the back of the book. And then, once you have a good handle on this, you can proceed to the section exercises. There are 8 problems in our section exercises. Let's do the odd numbers, except for when we have to do an even problem if that even problem is based on the odd. Okay, so section exercises 1 through 7, odd. That is our discussion on chapter 21, financial statements.